Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB, coming to you live from Barangaroo on the final Friday of the month and the final Friday, of course, of February. Just time stamping this that it is 3 Eastern, so the market has not fully closed. But of course, we are bringing you this show a little earlier because it is our last call special kicking off from 3:30. We're down 1% though in the final hour of trade. Just getting you caught along with the themes of the day. It really is finally finished. We're all sighing a final sigh of relief that February reporting season is done and dusted. It's been a big one. We have chatted to so many ASX CEOs and CFOs. You can find all of our coverage on ausbiz.com.au. There's a special tab, reporting season. I loved the line coming through from Michael McCarthy from Moo today saying it was at best a benign but grim reporting season. We're also watching a falling Star, with Star looking like it may have to be delisted from the ASX as it fails to meet so far its deadline to report its numbers. And of course, an ASX sell-off. I think yesterday was the only session where we had a small gain coming through, but it has been a week of selling, and several of our guests saying, is this a turning point now in the market in terms of we potentially have seen a peak at the beginning of the year and we may start to consolidate for the next few months. Let's have a look now at what our sectoral moves were. Kicking it off with the miners, which were hit hard today, particularly as we continue to see weakness with Donald Trump ramping up these China tariffs. So you've got some big falls coming through from the mining players. We're also seeing big falls in Chinese stocks as Trump says the US will impose an additional 10% tax on the Asian nations' imports, really leading to worries about intensifying trade tensions. Also having a look at what we saw today in the retail players. Harvey Norman looking very good on the back of its results, Lovisa as well, but Wesfarmers, JB Hi-Fi and Premier Investments were lower. And when it comes to the retail space, Charter Hall Centre, Goodman Group under pressure. Mirvac was up about 0.25%. Harvey Norman lifted its half-year profit by almost 40% to just under $280 million on the back of higher revenue from its franchises. Endeavour shares down by about 6% as it came through with its numbers. PEXA reporting a loss, but with underlying cash generation growing, and shares rose, as did Life 360. They're branching out into pet tracking as well. And Australian Finance under pressure following its results. A busy day on the earnings calendar. And of course, in terms of economic data over the week, let's welcome to the COB our guest Shane Oliver from AMP. We made it to the end of February reporting season. Shane, I know you look more at economics rather than the share market, but what sort of report card would you give reporting season?
Look, average at best, disappointing, I'd have to say. I think the market was looking for more evidence that we'd seen a bottom in earnings and that there would be improvement in prospect. I mean, some companies have certainly seen that. We have seen a slight uptick in the number of companies reporting profit growth on a year ago, and certainly up from where it was, say, back in 2023. But by the same token, these results are sort of running around average. You've got about 52% of companies reporting earnings up on a year ago. That is actually slightly below average. You've got about 54% reporting dividends up on a year ago, again, slightly below average. So a little bit better than where it was 2 years ago, but still not great. And the clincher, I thought, was the fact that at the start of the reporting season, 3 weeks ago when we were talking about this, we had more companies surprising on the upside. At the end of the reporting season, it's just slipped around the other way, 39% surprising on the downside on our count, 38% surprising on the upside. So slightly turning negative there. And of course, going hand in hand with all of this has been earnings expectation downgrades for this calendar year. And that's obviously a bit of a downer. It wasn't just the banks, they were a part of it. That set off the rot last week, but also resources companies, and it's been a bit broader than that. So somewhat disappointing. I think we will see improvement in the year ahead, putting tariff man aside, but by the same token, it's going to be fairly constrained. Obviously, lower interest rates and a pickup in economic growth will help, but I think the interest rate cuts will be relatively constrained compared to what you might hope for, and the pickup in economic growth likewise.
Well, let's talk about tariff man, because I note that you say there could be a high chance of correction if a lot of these tariffs come through. What are we seeing in terms of the likelihood Australia may also face some of these tariffs?
Look, I think that's quite high now. I know a lot of the focus has been on steel and aluminium. The government itself seems to be getting more pessimistic on that. America's, Trump's advisors seem to be urging, at least some of them, Navarro, that, we continue with those 25% tariffs on steel and aluminium. But it's a lot broader than that. America's talking about these reciprocal tariffs in April. And that would mean they could take a dislike to all sorts of things, like our biosecurity laws. They could regard that as discrimination against American companies. They could take a dislike to our GST. They could take a dislike to the media laws that impose fees on Google and Meta if they don't, in turn, reach agreement with the media companies. So there's all sorts of issues around this. And of course, we've got the he's also talking about tariffs on pharmaceuticals, and pharmaceutical exports from Australia to the US are double the size, more than double the size of our steel and aluminium exports. At the end of the day, though, I still don't see that as the main story for Australia. I know it will be the main headline for Australia, but the main danger for Australia is that all of Tariff Man's efforts just has the effect of, and I'm not being disparaging there, that's his own description of himself. He's called himself Tariff Man as far as I can tell. The reality is that this could have a devastating impact on global economic growth, which then has a flow-on effect to the demand for our exports. That's probably a bigger threat, given that our total exports to the US have a similar value to our exports to China in 2020, which were affected by restrictions at the time, and our economy sort of sailed through that. This time it would be different. Similar size restrictions in terms of those tariffs, but if global conditions are weakening on the back of all these tariffs, then you get more of a hit to our economy.
When you talk about the overall impact of the economy as well, let's not forget that we are awaiting a federal election being called. You have some interesting stats too on how this can kind of influence the markets.
Yeah, I mean, there's commonly a feeling that as you go into an election, things like consumer sentiment sort of tread water for a little bit because people don't know what's going to happen. And then, of course, it picks up thereafter. It's a similar story with the share market. There is some evidence that shares don't move much or just range trade in the period prior to the election. Then you get a bit of a relief rally afterwards. Now, it doesn't always pan out that way. 1987 was an obvious example where it didn't. 2007 was another one as we went into the GFC. And even 2022, when shares got hit by the inflation scare at the time. So it doesn't always pan out that way, but most of the time, providing you don't have those international effects, you tend to get a bit of a relief rally thereafter. Obviously, a lot at stake in this election in terms of what economists focus on. We want to see measures to get productivity up, to get living standards rising again. And that really requires a whole bunch of economic reforms that may be politically unpopular. So we're not feeling, as a bunch, I don't think economists are feeling overly optimistic on this. You could argue the LNP, the coalition, is probably a little bit more inclined to constrain spending, which I think is what's really needed, along with a whole bunch of other things, but I'm not altogether confident all those other things are going to be done.
So what does all this play, or how does all this play into as well what we're expecting from the December quarter economic growth picture out next week, and how that may impact the RBA too?
Well, I reckon those numbers are going to be on the softish side. We have got soft data out this week for construction and CapEx, or the week just passed. It could well be the case that business investment falls slightly. So we're going to have some better numbers on consumer spending. Public spending probably still strong, and a bit of an uptick in housing construction. But against that, I think we're going to see a contraction or detraction or a detraction from growth from net exports or trade, and a slight fall in business investment. So overall, giving you a number of about 0.3%, which isn't that different to what we had in the September quarter, and growth overall around 1%. So still remaining pretty weak. And of course, another thing is that even though we're going to get that pickup in consumer spending, it was largely driven by discounting, and therefore may not be sustainable, may not be as strong in the current quarter. So I reckon that's going to tell the RBA that things are still pretty soft out there. It just reinforces the case for rate cuts, along with those further rate cuts, along with the inflation numbers that came out in the last week, which I think were on the soft side.
And what else should we be more broadly looking out for next week, Shane? I think we've got obviously US jobs as well.
Yeah, jobs are the big one out of the US. And they're probably going to show, the labour market still remains reasonably solid there. So we're getting some softer numbers coming out of the US. It's not just consumer confidence and business confidence or business conditions, as we've seen in the last week and a bit. Retail sales, consumer spending looks to have softened off a little bit. Housing indicators are softer. But it's probably too early for that to show up in the jobs market just yet. So we're looking for payrolls up about 155,000, unemployment staying around 4%. But I would suspect that may not be a good guide to the future as these uncertainties continue to roll out of the US, out of the administration. Lots of announcements every day, sometimes contradictory. Lots of uncertainties amongst Americans as to whether they'll continue to see their services from the government. These things will start to weigh, but that shows up more in the months ahead. In Europe, we'll see a rate cut. I think that's Thursday. The ECB will cut again and signal more cuts ahead. I think they'd probably just do 0.25%, but more cuts ahead. And I think this will be a theme for lots of countries outside the US, where the main impact from all these tariffs will be to slow growth in these countries as opposed to push inflation up. I think it's more of an issue for inflation in the US than elsewhere, providing all these other countries, including ourselves, don't retaliate against US tariffs. But I think the biggest threat is to growth, and that therefore increases the case for central banks outside the US to continue cutting rates.
All right, let's keep thinking positive thoughts like that book behind you, Shane. Thanks as always, Shane Oliver there from...
I think I needed it this week.
We all do. Shane Oliver from AMP. All right, well, of course, we were chatting a lot about company results today, and the stock of the day was PEXA Group. Luke Winchester from Merewether Capital and Ben Richards from Seneca Financial Solutions join Nadine.
Is one we own and think is a buy, but like just looking at that chart, it has gone sideways. I'll be the first to stick my hand up and admit that, especially over the last year or two. However, this was a business that floated in a couple of years ago at about $17, and just kind of got the macro and the timing wrong and pulled back a fair bit. It is a monopoly player in, as the CEO said, a critical infrastructure. I like to think of it as the REA, realestate.com, but for back-end property settlements.
Like, to me, the thesis would be quite a simple one, which is a fair price for an infrastructure-like asset in Australia. And as long as you're seeing those green shoots in the UK, you're staying in this business. So despite not knowing it well, I'll say a buy as well, just because, even on back of the envelope numbers, I agree the valuation is not too steep for the opportunity that the UK could represent for them.
That was just a reminder of our fabulous guest, Shane Oliver from AMP. I am not surprisingly Shane Oliver, but just timestamping the fact that we are here at 3:30 p.m. Don't know why I'm still Shane. 3:30 p.m. Sydney in terms of the market not quite being closed, but let's have a look at where the market leaders are. PEXA rising after its results, Life 360 as well, up by about 9%. You can find a great chat we had with the co-CEO Christian Hulls on our website. Karoon Energy, Waypoint and TPG also doing well. To the downside in the session, Star Entertainment, of course, a lot of woes about its cash facility. Johns Lyng, Audinate, Neuron Pharmaceuticals, IDP Education. Let's have a look as well at the small end of town very quickly. We'll run through those. Fleetwood up 17%. To the downside, we had weakness coming through from the likes of Appen and, of course, Star. Monthly core PCE price index out tonight, and US goods trade balance as well. Busy week ahead, although not as busy as what we've had. We've got the Monday monthly inflation gauge for February, Tuesday RBA meeting minutes, Wednesday GDP growth, Thursday goods trade balance, and Friday household spending for January. All right, we love Shane so much, we're keeping his name up there, but let's have a quick look at where the market is finishing the day's trade, down by 1% on the CBO 200. We are going to have our the last call coming up. Stay with us. You're watching AusBiz.